Well, good morning. I make it dead on 12 o'clock, so let's get started with our webinar. Welcome to Grunberg & Co. Welcome to our webinar all around research and development tax relief. I'm delighted to be joined today by Nimesh Patel, who is the Senior Tax Manager at Grunberg & Co. He's joined by Assistant Manager Kalpesh Bharat, and also joined with Ollie Black, our guest speaker today. So welcome all. Our plan is to run this webinar for about 30 minutes. There is time for your questions. If you're familiar with Zoom, you'll be familiar with the Q&A panel. So please open that panel and use that to talk to us and put your questions forward, which we'll either cover as we go along, or we'll try and answer as many as we can live before the end of the webinar today. So I will at this point hand over to Nimesh. Over to you.
Thank you, Jo. Thank you everyone for attending this webinar. So just want to go through the contents. So in terms of what we're going to cover today. So we'll start off with a bit of background on Grunberg & Co, our firm, and then move on to a bit of background in R&D tax relief, some of the key aspects, how R&D relief came about, how long it's been around for, and then the technical criteria, which is focusing on what the company's activities need to be in order to qualify for R&D tax relief, and then the financial criteria, which focuses on the costs which the company must have incurred in order to obtain tax relief on those costs, and then the financial calculation basically will cover the main aspects of the tax calculation and how to claim the R&D tax relief itself. And then we'll finish off with some Q&A at the end. So Grunberg & Co, we've been going for over 30 years. We've been growing very rapidly, especially over the last 10, 15 years. We've got 7 partners, and our client base is mainly focused on owner-managed businesses. So R&D is an area which we come across very often, and we've seen a substantial increase in clients that are undergoing R&D work, and that's why we wanted to further increase the awareness of this tax relief, so that companies that are carrying on R&D activity aren't missing out on the generous tax reliefs that are available. And it's also one of the most underclaimed tax reliefs out there, and has been for a number of years. So that's a further reason to increase the awareness out there as well. So R&D tax relief was introduced in the year 2000. So it's actually been around for 20 years. And it started off with small to medium-sized enterprises. And then it was increased so that large companies could also claim R&D tax relief. And one of the most basic aspects is that this tax relief applies to companies. So if your business is not carried on by a company which is subject to corporation tax, then you won't qualify for the R&D tax relief. We are looking at companies that are carrying on activities where there is scientific uncertainty, and also companies that are trying to seek an advance in technology. And one of the misunderstood points is that the advance in technology just needs to be sought. It doesn't need to be successfully obtained. So there may be companies out there doing R&D work, lots of testing, lots of iterations, and may not actually end up with a finished product. But the fact they've actually attempted to resolve the scientific uncertainty would actually mean they are eligible for the R&D tax relief. And also another misconception is that only certain industries are fitting within this regime. R&D could actually apply in pretty much any industry, as long as there is an attempt to resolve scientific uncertainty and obtain an advance in technology. Then R&D could actually be claimed in industries where you may not think it would be applicable. One of the ones that comes to mind is actually the food and drink industry, where processes are changed constantly and there is a lot of time spent on R&D. So some of the things to watch out for in terms of whether the business may potentially qualify. So if the company is employing software developers, engineers, this could be an indication that the company is carrying on R&D activity. If a company is receiving innovation grants, so from Innovation UK, for example, then this means it's likely that they're doing R&D work, because in order to receive these grants, they need to show to some degree that they are actually carrying out R&D work. It may be that there's large subcontracting costs for building products, so that may indicate there's some R&D work going on. And the company that are being subcontracted to, they may also potentially qualify as well. So if you're paying another company to do this work, then they may also have a potential to claim R&D tax relief as well. And also, if a company's got valuable IP, then you'd be thinking, well, actually, hold on, how did the valuable IP come about? How is it created? And the likelihood is there may have been some research and development work done to create the IP that the company's got. And especially if there's a patent on the IP, then there is likely there may have been some research and development activity beforehand to arrive at the products. In terms of submitting the R&D claim itself, the company will need to produce a report. So this is quite a detailed report where we cover the company background, so what the company does as its activity, trading activity, the structure, what the company's aims are. And then we'd also want to include the technical staff that are working in the company, their background, their qualifications, the work they do, because they are a fundamental part of the R&D work the company does. And also a technical narrative which would explain the projects, the testing that was done, why there was scientific uncertainty, why it was difficult to resolve it, and also what the company did to attempt to resolve the uncertainty. And if they were successful, then they could put in something around how they managed to do that. And then also in the reports, you would also have an overview of the R&D costs that the company's incurred in order to work out the actual tax relief that can be claimed. So what will happen is that the company will have to produce a report, which is then submitted with their corporation tax return. So the two of them go together and they are submitted to HMRC, who will then obviously process the tax return and look at the report as well when they're looking to see whether the company qualifies. In terms of making the claim, the company has 2 years from the end of their accounting period to submit a claim for R&D tax relief. So, for example, if the company has a December year end, then the last accounting period would have been the year ended 31st December 2019. So that company would have until 31st December 2021 to submit their R&D tax relief claim. So there may be a scenario where the company didn't realise they qualify for R&D tax relief. So the importance of a 2-year time limit is because the company might need to go back to a previous accounting period to actually revise their corporation tax return and actually make a claim for the R&D tax relief. So quite often we come across new clients where we are not only making the R&D claim for the current accounting period and the one that's finished recently, but also the previous accounting period as well, so that the claim for R&D relief can be maximised. In terms of HMRC's role, once the claim has been submitted, it will need to be processed. If the company is loss-making, then they're able to claim what's called an R&D tax credit, which is actually a cash payment where the company has realised a loss and they actually effectively give up their losses so they can receive a tax repayment from HMRC. The turnaround time for that is usually 4 to 6 weeks. from the date of submission. But obviously, where the company's got a year end which is quite popular, such as December or March, then the turnaround time can actually vary depending on the number of claims that HMRC are dealing with and the number of repayment requests they actually need to be handling. So actually, this is actually quite a good time to be submitting an R&D claim, because the rush in terms of dealing with claims that have been submitted after March has been dealt with mainly. And if you were to make a claim now and submit it now, the turnaround time wouldn't be as long as it could be. And just as I mentioned earlier, if the company is loss making and it's a small to medium sized enterprise, then they'll be getting a cash payment from HMRC. So that's one of the key benefits. And especially in these times, it's actually a good source of government funding as well, where the company's done R&D work. And a lot of startup companies that do R&D work, they rely on this tax repayment from HMRC. It's actually one of their biggest sources of funding they have. So it can actually be a really good way to help the company grow and actually do further R&D work. So I'll hand you over to Ollie, who will go through the technical criteria.
Hi there. So as Nimis was mentioning, so in order to qualify for R&D tax relief, there's technical criteria that you'll have to meet in order to qualify. So these criteria are actually applied on a per project basis. So let's say your company has 4 or 5 different overall projects, you would have to apply these criteria to each project, and they would have to meet all of the criteria in order to qualify. Now, obviously, depending on how the company is set up and what exactly you do, you may only have one project, one overarching project, and therefore we'd only apply this criteria once to check if you would qualify. And that's kind of where they would fit in. Once we've then checked if you meet the technical criteria, we would then move forward to looking at the financial criteria and what costs are associated to the project. So I'll quickly run through the technical criteria. They're actually quite simple, but the understanding of them can get a little bit complex. And one thing to bear in mind as well is that the criteria for R&D in the UK is exactly the same as the criteria for R&D across most other countries that have R&D schemes. Now, they're based on an old manual from the EU, and that's why most countries around the world share the same criteria, because they're all pretty much from the exact same source. Now, there are 2 main criteria, technical criteria, that you'd have to meet to qualify for R&D tax relief. The first one is that you have to seek or have sought to achieve a scientific or technological advancement. Now, a technological advancement is a gain in knowledge above the state of the art. So by a gain in knowledge above the state of the art, I'll break that down into a few different explanations. So state of the art is any information in the public domain. So let's say you're a software company building a mobile application, for example. The state of the art will be any documentation that's readily available, any online forums or any other boards that you may talk to on there. That is what we would call the state of the art. That's the publicly available information. Then we would also look at your competent professionals within the company. So competent professionals is a word used by, or phrase used by HMRC to describe people within their field who are competent. So if you're a software developer, this could mean you have a degree in software or you've worked in the field for a number of years. They actually use the term competent professional in a way to say, if that person would know how to look for the information, they're a competent professional. For example, an architect wouldn't know what to go on Google and look for in a software project to get information that they currently know, but a software engineer would know the right term to look for and the right resources to get information for a project. So that is the broad definition of a competent professional. Now, a technological advancement is if your competent professionals within your company have gained new knowledge that wasn't previously in the public domain. So let's say I'm a software developer and I'm trying to integrate 2 different softwares together, and I've looked online and I can't find any resources as to how to do it. So I've experimented myself and I've come up with a new way of doing it. I have therefore gained new technical knowledge as to how to do that integration. Now that is what the technological advancement is. One thing also which Nimesh mentioned earlier is about failures. You don't actually have to succeed in doing this. So in finding out how not to do something, that is exactly the same and can qualify just as much as learning how to do something. If anything, it's actually more important, because part of why the R&D scheme exists is to reward risk-taking companies, and it's to almost help fund people through that risk-taking process. Now, in finding those failures, you're becoming more efficient as a company, and your competent professionals are becoming more efficient and better at their jobs as well. So if you were to do the same project again, would you do it quicker? If the answer is yes, because we learned how to technologically do something or how to not do something, that is kind of the main point of the technological advancement. Okay, so that's the first criteria. Now, the second criteria is that while trying to achieve these technological advancements, you have to attempt to overcome uncertainties. Now, uncertainties are really the challenges within your project. It can't be straightforward. If I were to go out to integrate software A with software B, and all it was me typing a line of code saying 1 + 1 = 2, and it took me 5 seconds to do, that's not very challenging. So the bulk of the R&D needs to come from the challenges that you've had, where you go through that iterative process. You're uncertain if it's going to succeed in the first place, or if you're sure that the overall project will eventually succeed, you're unsure about the steps that you have to take to get there. That's the uncertain part. That's linked to the risk-taking part of your company. So the main areas of the uncertainties are actually used by HMRC for a number of purposes, which we'll go through it probably in the next slide slightly with the financial criteria, is that when you're looking at the costs, HMRC uses the uncertainty to define the start and the end date of when you can claim. So once you have had your first technological uncertainty, that's when you can start claiming your costs. And once all technological uncertainties are resolved, that's when you can claim until. Now, the reason for that is that once your uncertainties are resolved, you're then pretty much in that bug maintenance stage, not learning any new knowledge. It's just maintaining something that you've already done. So it's almost like little bubbles of challenges and uncertainties that we'd be looking at for your R&D project. Now, as mentioned before, failure is good. Let's say you have an entire project and you go through lots of different challenges for it and they all fail. That's good for R&D. Might not be good for other aspects of the company, but for R&D purposes, that's a good thing. And one thing I would always make sure to do is, if you feel you're having technological uncertainties throughout the year, or what you think may be technological uncertainties, is to make note of them. Because these are the sort of day-to-day challenges that you have that a year or two later, when you might actually come to do your R&D claim, are quite hard to remember. So I would always jot these down. And when speaking to R&D consultants and people who would put together your claim, then what they would normally look at is the technological uncertainties. That's normally how they're assessed. And HMRC, the first pages in your report that we go through, that's really the ones that they're looking at. Say, did you actually have a tough time doing this? Did you actually have iterations? Did you go through that process of trying to solve technological challenges? And that's really the main area. One thing, and a definite thing I see a lot of companies do with this, is there's a bit of a fine line between a technological challenge and a commercial/business challenge. So if you've had to change something in your product because a client said they didn't like it, move the button from the left side of the screen to the right side of the screen, those sort of things may be commercial decisions, and they're not directly related to why it might be hard technologically to implement. So we'd always need an underlining aspect of technology and why it was hard to do from a technological or scientific point of view. I hope that makes sense for everyone on there. And that's pretty much it for the criteria. So once you meet both of those for a project, you're all good to go on to the next slide, which is financial criteria.
Okay, so I'll take you through the financial criteria. There's two R&D schemes. One is the large company scheme, which they can claim RDEC for, which we'll go through in the next slide. And there's the SME scheme, where small, medium entities can claim 230% R&D. Now, these small, medium entities are defined by less than 500 employees, less than 100 million euro turnover, or 86 million gross assets. The qualifying costs for these for R&D are payroll. Now, payroll, it's not just salary. You have to include. You can include employers' NIC. You can include pension costs, which relate to the specific employees. There's externally provided workers, freelancers paid through a limited company, subcontractors. Now, externally provided workers and subcontractors, there is a difference. Ollie's just going to expand on that in terms of what the difference is.
Yeah, sure. So they sound quite similar, externally provided workers and subcontractors, but the main difference of them is really autonomy of who they are. So an externally provided worker is what most people normally think of as a freelancer. Someone who works under your control, they work on a time and material basis, almost like an employee. Those are externally provided workers. Now, in order to claim for one of those, you need to be paying through a third party. So if you're employing Joe Bloggs as a contractor, you would have to pay them via Joe Bloggs Limited, and then Joe Bloggs Limited would then pay themselves or another arrangement through that company. So that's an externally provided worker, time and material based, and they work like an employee. Now, a subcontractor is someone who you give either a fixed fee and a deliverable. So let's say we use an example for a software, and you've built a platform, and you need an external firm to test that your platform is secure from any external attacks that you might have, or cyber security. So you employ a firm to do penetration testing of your platform, and you pay them £10,000 as a fixed fee. They go off, they do their own work. You're not in control of their day-to-day job that they do, and they give you a deliverable at the end of it. That is a subcontractor. Now, with subcontractors, you can pay them via a limited company. They can even be individuals. So if there's an individual that does penetration testing of their job, you can pay them directly to do that for you. The fixed fee part is a bit more grey, because sometimes companies will work out their fixed fee based on an estimate of how long it's going to take them to do. But really, the core element is that you aren't in control of their day-to-day and what they're doing, and they'll deliver a fixed deliverable at the end of the project. So that's really the main difference between the two.
Okay, so I'll carry on with software licenses. Software licenses, please be careful. Hosting costs. If hosting costs don't relate directly to R&D, they're not allowable as R&D costs. We've experienced that with a few of our clients, but with hosting costs, you just have to be careful. If they don't relate directly to R&D, they're not allowable. Consumables. Now, consumables are light, heat, water, which are directly consumed in R&D. Rent is not a qualifying R&D expenditure, and you can't claim the extra 130% on rent, as it's not qualifying for R&D. Independent research, that's if you pay any external organization such as a university. This is only for large companies. You pay them a lump sum, and that can be allowed for R&D, and if it relates directly to the R&D. Qualifying indirect activities. These are such as costs as training, management, recruitment fees, which indirectly relate to the R&D, can be allowable for the extra 130%. R&D percentages. Now, what we mean by that is when you're claiming percentages of employee costs, you have to be careful. HMRC will always argue that 100% of these employee costs, particular employees' costs, will not be allowable. So when you're making when you're working out these percentages, just please make sure that they're reasonable and justifiable, so that they can so you account for a reasonable amount of the employee salary. It could be 80%, 70%. You've got to estimate exactly how much that in particular employee spent on R&D. Types of benefits in terms of what you get for you get the extra 130% for small, medium entities. Now, if that creates a loss, that loss can be carried back. It can be carried forward. You can group relief it. You can claim a credit, which I'm going to go on to in the next slide, of 14.5%, or you can reduce your profits if you're not creating a loss, which again gives you a tax relief of 19%, which is the corporation tax rate. So the financial calculations included in the in your corporation tax return, it's part of your tax computation. SMEs, like I said, is the extra 130%. So 230% is the enhanced expenditure, which is the 100% expenditure plus the 130% of enhancement. You get between 19 to 33% cash back on qualifying costs. What we mean by that is 19% for profit-making companies and approximately 33% for loss-making companies. Is the approximate cash back that you receive on these expenses. 14.5% tax credit. Now, the tax credit is worked out on the lower of qualifying expenditure and unrelieved losses, and you would get a 14.5% credit, which would be repayable to you. This could be if there's losses. Again, what I went through in the previous slide, the rebate can be carried. The alternative is carry back, carry forward, or group relief. For large companies, there's a different relief, which is called the RDEC. It's 13% from 1st of April 2020. It was 12% prior to that. It's a taxable credit, so you receive, so on your R&D costs, you receive 12%, sorry, 13% taxable credit, which is taxable, so it's taxed, and then you after tax you deduct the credit again. So reasonably, you get approximately 10% cash back on your costs with the large company scheme. Now, you can use the RDEC scheme if you don't qualify for the SME scheme as well, and they both can be used together as well. Yeah, so that's the financial criteria.
Maybe if I quickly as well give just an example of in real terms how this would look potentially, where let's say your company is, I don't know, £100,000 in profit for the year, so you're due around roughly a £20,000 tax bill. So let's say that's your current situation. Then you go and you decide, okay, we meet the technical criteria, we have a project that we think meets. I've got roughly £100,000 of staff costs, and maybe half of that is R&D. So let's say 50% of my cost is R&D. So I have £50,000 worth of R&D qualifying expenditure. You would then use, as Kalpesh was saying, the 130% uplift on that £50,000, which would mean £65,000 of an R&D claim. That will then be minused off of your £100,000 of profit, leaving you with £35,000 of profit for the year. And you would then only have a tax bill of £7,000 as opposed to £20,000 beforehand, giving you a real benefit of £13,000 for that year. for that R&D claim. And that's roughly how it will equate if you're profit making. Now, if you're either break even or loss making, the same calculation applies of giving you an additional loss. And as Calpesh said, you get the 14.5% tax credit. So if this pushes you £100,000 into a loss, you can sacrifice that at 14.5% and you'll receive 14.5 grand from HMRC as an actual check in your bank account. And that's roughly how the scheme actually works in real term.
Yeah, and I would like to just add, we do get scenarios where the company might actually be forecasting a profit for the following year. So they may decide not to claim the tax credit, but actually just to carry forward the loss and get tax relief at 19%. So there is that to look at as well, if the company is going to be realising a profit in the near future.
So also, just to answer the question in there from Claire, just in relation to a strategy consultancy firm. So it would actually need to have a basis in either a science or technology, such as software. If it's just in the approach itself, unfortunately, that wouldn't meet the criteria. It would need to have a backing in an actual field of technology for this case. The human science is a bit of a grey area where HMRC are normally, they don't normally like that. They normally put a cross through any sort of human science. But if the human science has a link to software, so let's say you were trying to solve a certain approach for a company, and in part of that you had a software for them to log in where you can talk about things, or it would have some sort of artificial intelligence or something that would process something in a software for them, then potentially the work that you've spent on the human science would be allowable as a qualifying indirect activity of the R&D project within the software side. So this is where, as mentioned before about the QIA, so that work that you spent outside of the software could then be relatable to the advancements and the uncertainties undertaken during the software development side of things. Now, I don't want to go down a hole of just saying it's only software companies. I've had companies claim that are all over the field before. I've seen restaurants, I've seen scaffolding companies, I've seen a milk bottle company, I've seen most companies you can imagine at some point have some relation to doing R&D, but it will need that link to either a hard science or technology. And then whatever you do around that can then be linked as an indirect activity of those core elements. So I hope that helps answer that question slightly.
Okay, so I think we can move on to our Q&A session. So if you've got any more questions, please do let us know.
Hi, Nimish. We've got one here from Peter. It says, what actions does a company need to take to ensure they get both R&D and access to the patent box?
Ollie, do you want to?
Sure. So I'm less into doing the patent box claims myself. My main focus is normally on R&D. But in terms of the patent box side of things, obviously you get a decreased rate of tax for doing patent box, and a lot of the time some of the work that goes into putting a patent box claim can be reusable in parts of an R&D claim as well, because when you actually go and delve deep into that research of what you've done for a patent, a lot of the time in your patent applications, in the research that you've done to checking what is in the state of the art. So as part of a patent application, you normally need to check that no one else has done it before. There's a lot of research that goes into doing that. And a lot of that work that you do can be related into an R&D claim. So a lot of it covers both sides of things in terms of the knowledge. Okay, well, that answers the questions we've had put forward.
Thank you, Nimesh, Ollie and Kalpesh for your contribution today. To our guests, we will make a recording of this webinar available on demand and send you the link for that. It will also be available on our website. So thank you very much for attending, and we look forward to our next one.